Hi, welcome back to the channel. In today's episode, I want to talk about China because we've just had another major batch of economic data, and unfortunately for Beijing, virtually everything appears to be moving in the wrong direction. Industrial production has slowed, consumer spending is incredibly weak, investment is falling, the property market remains deeply depressed, and all of this is happening just as China enters the second half of a year in which the government is targeting economic growth of between 4.5 and 5%. So this is important because China needs the economy to accelerate from here. Instead, the latest figures suggest that it may actually be slowing down. And that matters not only for China, because China is the second largest economy in the world, the biggest importer of oil on the planet, an enormous buyer of raw materials and commodities, and one of the biggest markets for businesses and countries all across the globe. So if the Chinese economy is starting to lose momentum again, this could have some pretty serious implications for the global economy. And there's another major problem hanging over China right now: energy. The war in Iran has completely changed the economics of global oil and gas markets. China has so far managed to protect itself from some of that shock by dramatically reducing imports and drawing down on the huge reserves that it accumulated before the war started. But reserves are not an unlimited source of oil, and if China eventually has to return to the international market in a much bigger way while supplies from the Middle East remain constrained, that could have some very interesting consequences for both China and global oil prices. So there's a lot to go through in today's video. And for those who've been missing the graphs, there are a couple of really good ones in today's episode. So we're going to get into those straight away. But before we do, if you're enjoying my economic updates, then please give this video a thumbs up, as it really helps with the algorithm and puts a smile on my face. If you haven't done so already, please subscribe to the channel. And if the hype button, which is that funny little symbol alongside the thumbs up, is available, then please hit that as well, because it really helps to push this video to a much wider audience. Okay, so let's start with the first graph. And this is really useful because it shows just how widespread the latest deterioration has become. We're not simply talking about one disappointing number here. Industrial production increased by 4.5% compared with last year. Now, 4.5% might actually sound reasonably healthy, but in June, industrial production was growing at 5.3%, and economists were expecting the figure for July to come in at 4.8%. So not only has the number slowed quite sharply, it's also come in below expectations. And when we look underneath that figure, we can see the same basic problem that's been developing within the Chinese economy for some time. China can produce. What it's struggling to do is generate enough demand. China's own National Bureau of Statistics has described the imbalance between strong supply and weak demand as acute. And that is a pretty extraordinary admission, because if you keep producing more goods, but consumers and businesses aren't buying enough of them, ultimately something has to give. Prices come under pressure, corporate margins get squeezed, companies become less willing to invest, and eventually production itself starts slowing. And that takes us to the next number on this graph: retail sales. This is one of the figures that I always think is really important when we're looking at China, because Beijing has spent years talking about trying to rebalance its economy. China doesn't want to be permanently dependent on building things, investing in infrastructure, and exporting manufactured goods. It wants Chinese consumers to spend more money. But July retail sales increased by only 0.6%. That's not 6%, it's 0.6%. In June, the figure was already sitting at a pretty weak 1%. But economists were expecting the figure for July to come in at 1.5%. So once again, China has missed the expectations. And when you consider that this is an economy which the government wants to grow by somewhere between 4.5 and 5% this year, consumer spending growing by less than 1% is clearly not where Beijing wants to be. There's still spending taking place in certain areas. Services have been performing better than goods. Online spending is continuing to grow. Technology-related parts of the economy remain relatively strong. But the broader picture is that Chinese households remain cautious. And one of the biggest reasons for that is property. Which brings us on to the second graph, because I think this is potentially the more worrying of the two. Investment in fixed assets fell by 6.7% during the first 7 months of this year compared with 2025. And importantly, that decline is getting worse. At the end of June, the fall was 5.7%. Now it's 6.7%. So rather than stabilizing, investment appears to be deteriorating. And when we break that down, things become even more concerning. Infrastructure investment is down, manufacturing investment has also fallen, and private investment is down sharply. And real estate development investment is down by more than 19%. That is an enormous contraction in something which historically has been one of the key engines of economic growth in China. Property sales are also continuing to fall. The floor space of newly built commercial buildings sold during the first 7 months was down by almost 12%. The value of those sales was down by around 13%, and new home prices were around 3% lower than they were this time last year. So despite everything Beijing has done to try to stabilise the property market, this enormous economic problem has not disappeared. And property matters far beyond construction. If you own a house that's falling in value, you suddenly feel poorer. If you bought an apartment from a developer that's struggling financially, you become very nervous that it might not actually be completed. We talked about Evergrande a lot, and there are a lot of unfinished apartments by not just Evergrande but lots of other property developers. If developers aren't building, they aren't buying steel, copper, cement, machinery, or appliances. Local governments receive less revenue from land sales, banks have more exposure to stressed borrowers, and consumers become much more careful about spending. That helps explain why retail sales remain so weak. It's all connected. And the really interesting thing here is that China essentially has a two-speed economy. There are parts of China that are doing extremely well. High-tech manufacturing is very strong performances. Production of industrial robots is growing very rapidly. I know that sounds bizarre, but it's true. Lithium-ion battery production is increasing. China remains incredibly competitive in electric vehicles, electronics, renewable energy equipment, and increasingly artificial intelligence. Exports have also been extremely strong. In fact, exports have become one of the major things holding up the Chinese economy. But that creates another vulnerability. You can't indefinitely rely on selling more and more products to the rest of the world while demand inside your own economy remains weak, particularly when the United States and other countries are becoming increasingly concerned about Chinese imports and industrial competition, and particularly subsidies. So China needs domestic demand to start doing more of the heavy lifting, and so far that simply isn't happening. All of this leaves Beijing with an increasingly difficult growth problem. The official target for this year is growth between 4.5 and 5%. It's been 5% historically, but it's been slackened a little bit to 4.5 as a spectrum, with the government saying that it would like to achieve an even better result if possible. China grew by 4.7% in the first half of 2026, so technically it remains within that 4.5 to 5% range. But if you think about what that means, if you've grown by 4.7% in the first 6 months and the economy is now losing momentum, there isn't a huge amount of room for things to deteriorate further. China really needs the second half of the year to remain relatively strong. Instead, July, which is the first month, has started the second half with weaker industrial production, weaker consumer spending, and a deeper contraction in investment. That doesn't necessarily mean that China will miss its target entirely. Beijing has significant firepower and can pull a number of different levers. It can increase government spending, it can accelerate infrastructure projects, it can tell state-owned banks to lend more money, and it can cut interest rates or reserve requirements. It can also introduce more subsidies to encourage people to buy cars, appliances, and other products. But the question is whether those policies actually fix the underlying problem, because China's already spent years trying to stimulate an economy that has too much debt, too much property, weak consumer confidence, and an enormous dependence on investment. Borrowing more money to build things may increase GDP in the short term, but it doesn't necessarily make Chinese households feel confident enough to go out and spend. And there's now another major problem making Beijing's job more difficult: the energy shock. China is the world's largest importer of crude oil. For the 5 years before the Iran war, China was importing around 11.5 million barrels of oil every single day. But since April, that figure has dropped dramatically. China has been able to do something that many other countries simply can't do. It built enormous strategic and commercial oil reserves before the crisis started. So rather than competing aggressively for expensive barrels when supplies through the Middle East became disrupted, China reduced its purchases and started using some of the oil it had stored. During May, estimates suggest that China was drawing roughly 500,000 barrels per day from inventories. In June, that increased to around 1 million barrels per day. At the same time, China's seaborne imports collapsed. That strategy has done two things. Firstly, it protected China, and secondly, it protected everybody else. Because imagine what would have happened to oil prices if the world's biggest oil importer had continued purchasing 11.5 million barrels every day at exactly the same time that millions of barrels of Middle Eastern supply disappeared from the market. Prices would have gone significantly higher. China stepping away from the market freed up oil for other countries. But here's the problem: you can't draw down on reserves forever. Interestingly, in July, China appears to have started adding a small amount of oil back into the inventories. But that wasn't necessarily because the energy crisis has disappeared. It was partly because China's refineries processed less oil. And that itself could be another indication of weaker demand within the Chinese economy. So we now have this fascinating relationship. China's weak economy is reducing its demand for energy. That helps prevent global oil prices from going even higher. But high global energy prices are simultaneously making China's economic problems worse. It's becoming a vicious circle. Higher oil prices mean more expensive transport. They raise costs for manufacturers. They increase the price of petrochemicals. They make aviation more expensive and increase logistics costs. And because China imports enormous amounts of energy, some of that money effectively leaves the Chinese economy and goes to overseas producers. Natural gas is also important for China. Asia has been one of the regions most exposed to the disruption of LNG flows from the Middle East. China has diversified its energy supplies more than many countries and has pipelines bringing gas from Russia and Central Asia. It has enormous renewable energy capacity. It produces substantial amounts of energy domestically. So China is certainly not defenseless, but it can't completely isolate itself from a major global energy shock. And if oil remains expensive for an extended period, the impact will compound. Every additional month means higher costs. Every additional month will mean more pressure on corporate margins and make policymakers' jobs more difficult. So where does China go from here? Well, I think the big question is stimulus. These figures are almost certainly going to increase pressure on Beijing to do more. The Chinese government has already promised more proactive fiscal policy. It can accelerate public spending. It can support consumption. It can intervene further in the property market. But China has to be careful. If it throws enormous amounts of money at the economy, it risks creating even more debt and more inefficient investment. If it doesn't do enough, growth could continue slowing. So that's the dilemma. And we also shouldn't ignore the international trade situation. One of China's great economic strengths at the moment is its exports. But relying on exports becomes increasingly risky when governments around the world are talking about tariffs, trade barriers, and protecting their own industries. If domestic demand is weak and foreign countries become less willing to absorb Chinese production, China could eventually find itself squeezed from both directions. And that brings us on to why all of this matters for everybody watching this video. China is simply too big to slow down without the rest of the world noticing. It's the world's second largest economy. It's one of the largest trading partners for dozens of countries. It buys enormous amounts of oil, gas, copper, iron ore, and other raw materials. So weaker Chinese growth generally means weaker demand for commodities. That can hit major commodity exporters such as Australia, Brazil, and countries across Africa and the Middle East. European countries are also heavily exposed. German manufacturers have spent decades selling machinery, vehicles, and industrial products into China. Luxury businesses in France and Italy depend heavily on Chinese consumers. American companies, including Apple, Tesla, Nike, Starbucks, and many others, have spent years trying to access the enormous Chinese consumer market. If Chinese households become more cautious, all of those companies will feel it. And then there's global trade. China is at the heart of an enormous network of manufacturing and supply chains stretching throughout Asia. Slower Chinese demand affects South Korea, Japan, Taiwan, Vietnam, Singapore, and many other economies. So a slowdown doesn't stay contained within Chinese borders. It will spread. And that's why I think these latest figures are important. This isn't a story about China's economy collapsing today. China still has enormous strengths. It has huge manufacturing capability. It dominates many emerging technologies. Exports remain strong. And the government has enormous financial and political power to intervene. But the direction of travel is very concerning. Consumer spending is barely growing. Investment is falling sharply. The property market remains deeply depressed. Industrial growth is slowing. And all of this is happening against the background of expensive energy, geopolitical uncertainty, and continuing disruption caused by the war in Iran. China started 2026 hoping for growth somewhere between 4.5 and 5%. After 6 months, growth stood at 4.7%. Now the second half has begun, with almost every major domestic indicator weakening at the same time. So the big question is whether Beijing can turn this around, or whether the world's second largest economy is heading into an increasingly difficult second half of 2026. And if China does slow more sharply from here, this simply won't be a China problem, because an economy this large loses momentum. Eventually, the shock is going to be felt all across the world. So hopefully you've enjoyed today's video, you found it useful, informative, and most importantly, thought-provoking. If you've liked what I've said, then please give me a thumbs up. Please subscribe to the channel if you haven't done so already. If you've got it available to you and you see that hype symbol alongside the thumbs up, then please hit it, because it will help promote this video more. Thank you so much for your support, and thank you so much to everyone that's supported me in other ways. If you've bought me a coffee, or sent me a YouTube super thanks, or signed up as a patron or a member, thank you for that support. It really does help to keep me making these videos. So without it, I don't think I would still be doing it. So thank you so much, and I'll see you again next time.